The market crashes 30%. Then it recovers completely. But somehow you're still down money. This isn't bad luck, it's psychology. And in the next few minutes, I'll show you the exact 3 mistakes that cause this and how to avoid them before the next recovery happens. Here's what nobody tells you. Market recoveries don't fix investor mistakes, they expose them. While the S&P 500 bounces back to new highs, millions of people are sitting there wondering why their portfolio is still red. The market recovered, but their money didn't. And there's a specific reason why. Most people think losing money in a crash is about bad timing. It's not. The real damage happens during the recovery, when you think you're being smart. There are 3 psychological traps that activate the moment markets start climbing again. And if you don't catch yourself falling into them, you'll watch everyone else get rich while you stay broke. Let me show you what actually happens. Imagine the market drops 30% in 3 months. Your $10,000 is now worth $7,000. Painful, but you hold on. Then the recovery starts. 6 months later, the market is back to where it started. But when you check your account, you're not at $10,000. You're at $8,500. What just happened? Here's mistake number 1, and it's the most obvious, but also the most common. You sold at the bottom. Not all of your portfolio, just some of it. Maybe 20%, maybe 30%. You told yourself it was cutting losses or getting defensive. But the truth is, your brain interpreted falling prices as danger, and danger triggers escape behavior. This is why selling feels good in the moment. You're stopping the pain, you're taking control, except you're not. You're locking in losses right before the recovery. And now, when the market climbs back up, you're missing 30% of your original position. The market recovered fully, you didn't. Now here's where it gets worse, because even if you didn't sell during the crash, there's a second trap waiting for you during the recovery, and this one feels like you're being smart. Mistake number 2. You waited too long to get back in. The market starts recovering, you see green days, but you don't trust it yet. You think, it's just a bounce, it'll drop again. So you wait for the right moment. Except that moment never comes. The market doesn't send you an email saying, recovery confirmed, buy now. It just keeps climbing. And every day you wait is a day you're not participating in the gains. By the time you finally feel confident enough to buy back in, the market has already recovered 60% of its losses. You missed the entire first half of the rebound, the part that moves fastest. People who understand this think completely differently about crashes. They don't see falling prices as danger, they see them as opportunity. But there's still one more mistake that catches even the smart investors. Mistake number 3, you bought the wrong thing during the recovery. This is the sneaky one. You didn't panic sell, you didn't hesitate, you actually bought during the crash. But instead of buying what was falling, you bought what felt safe. You rotated into bonds, gold, defensive stocks, anything that wasn't bleeding as badly. Here's the problem. Safe assets don't participate in aggressive recoveries. When the market roars back, tech stocks might gain 50%, growth stocks might double. But your safe portfolio, it inches up 8%. The market fully recovered, your portfolio barely moved. You were invested the whole time and still lost money relative to where you started. This is where most tutorials completely fall apart. They tell you what not to do, but they don't tell you what to do. So here's the framework that actually works. It's 3 rules, and if you follow them, you'll never lose money during a recovery again. If this is changing how you think about investing, you'll want the next video too. Rule 1. Remove decision-making during crashes. Your brain is not built to make rational choices when your account is bleeding, so don't let it. Set up automatic investments that keep buying on a schedule no matter what the market does. This eliminates panic selling, eliminates hesitation, and forces you to buy when prices are lowest. You're not being brave, you're just being consistent. Rule 2. Own the whole market, not the good parts. The stocks that fall hardest during crashes are often the ones that recover fastest. But you can't predict which ones, so stop trying. Buy a total market index fund and hold it. When the market crashes, you own everything that's falling. When it recovers, you own everything that's rising. Boring works. Rule 3.
rebalance into fear. If you insist on holding bonds or cash for safety, fine. But use them correctly. When stocks crash and your portfolio shifts to 70% bonds and 30% stocks, that's your signal. Sell some bonds, buy stocks. Force yourself to buy what's falling and sell what's stable. This is how you turn market crashes into wealth-building events instead of wealth-destroying ones. But here's the thing nobody wants to hear. If you skip this step, everything I just explained was useless because knowing what to do and actually doing it when your account is down 30% are two completely different things. The next crash will feel different. It always does. And your brain will invent new reasons why this time is different and you should wait, sell, or hide. Now you know why this never worked before. It's not that you picked bad stocks. It's not that you had bad timing. It's that you fought against your own psychology without a system to protect you from yourself. Markets recover. They always have. But your portfolio only recovers if you stay in it, keep buying through it, and resist every instinct to do something smart that's actually just fear wearing a disguise. The market will crash again. That's guaranteed. But whether you lose money during the recovery, that's optional. You now know the 3 mistakes, the 3 rules, and exactly what separates people who build wealth from people who watch it happen to everyone else. The only question left is which one you will be next time.